So these principal reductions are going to happen, and over the years the market is going to settle out at, guess what? Market price. So if you're in Riverside, California, and your home is worth $200,000, guess what? In a few years your whole neighborhood is going to settle out at about $200,000, and most people are going to have about $160,000 mortgage on those homes. Hopefully the interest rates will still be low and those payments will be reasonable. But that's going to happen. And all the fumbling and bumbling and dropping of the ball that is going on, a lot of people think, with the administration and the banks and all this, some of it's very carefully orchestrated to raise hopes and dash hopes in a very scientifically calculated way so that all of us don't freak the heck out. Because guess what? Financially, we're screwed. And the sooner you get to understand how screwed you are in your home situation and take action and get up to the front of the line to get your financial bailout, the better for you. So it's not group grope anymore, and we're not like a bunch of lemmings, people who are paying attention to us. Listen up. Get your loan modification, everyone. Get your principal reduction. Get your second mortgage debt settlement. Wake up. Break out of your stupor. It's a new day. Take action and get financial freedom on your real estate. So I want to talk about how some of these debt or principal reduction programs are going to start coming out, because some of the banks have started to mention them. You know that Wells Fargo and Bank of America have announced major principal reduction programs, and they're a good prototype, and so I want to talk about them for a minute. They're a good prototype for the kinds of things that you're going to see in the initial years of these principal reduction programs. There's going to be private funding programs, and we've talked to you about several of those, where private money is going to come in and try to buy out toxic assets from the major banks and then rewrite those mortgages in a way that, like let's say they can buy them at 50% of their value, then they'll rewrite them to homeowners at 60%, and the homeowner will have a mortgage that's about the value of their home. That's a good solution. There are also going to be solutions that are government sponsored. Watch for the HAFA program and the HAMP program to be expanded to compensation to allow banks and to encourage homeowners to work it out and figure out a way to get to a reduced principal. But some of the half-baked ways that the banks themselves are going to participate is, again, going to be carefully orchestrated to keep the politicians at bay, to make, so that the politicians can say the banks are taking some action, don't force us to force them. And to prevent all of us from taking all of our money out of Wells Fargo and Bank of America and selling those stocks, they have to take some action. So both of them have announced programs. Wells Fargo is about $3 billion, and while that sounds like a lot of money, it ain't. It ain't in terms of what we have given to Bank of America, excess that we've paid over real value of their stock, and the amount of profits that they can make in a week. So $3 billion is not a lot of money, but it makes good press. At least it's more than hundreds of millions. So $3 billion is what they've committed, and they have committed to write down those mortgages. Well, whoopee ding. Those mortgages are toxic assets, and they either write them down, or they get them back in foreclosures, or they force people to sell them short and they get the write down. So it's going to happen to them anyway. So it's a lot of blah blah and it's a lot of hype. But here's how the programs are going to work for those of you who want an introduction to how these programs are going to sound. Bank of America has already notified apparently about 10,000 of about 45,000 homeowners that they think will qualify for this first round. And the loans are, as you'd expect, particularly toxic. They are the option arm, the pick-a-pay loans, the ones that are really, really negative, where people these days are actually still choosing that lowest payment because that's the highest one they can afford. So they're literally going into debt deeper and deeper every month. The home value is dipping like this, and the amount they owe on the home is climbing like this. It's not good for them. It's not good for anybody. It's not good for the bank. It's not good for communities. It's bad. So those are the loans that they've targeted. There are no Fannie Mae or no Freddie Mac loans, no FHA-backed mortgages, because those have other safety nets that Bank of America can take advantage of. So this is all very, very well and good. So they're subprime, and the homeowners must be significantly underwater, and they must be significantly past due. So hats off to B of A for being willing to write down principal on these mortgages. I mean, whoopee dang. But here's how it's going to happen. And this comes right from a press release from B of A. If a delinquent borrower owed $250,000, say, on a home that's now worth $200,000, what the bank does is takes that $50,000 that is lost equity, negative equity, and takes it off the loan and holds it in a suspense account. They no longer charge interest on it. The homeowner no longer pays interest on it, but it's in a suspense account. And each year that the borrower successfully makes payments, some of that amount would be forgiven. So you can see it's a cautious way, and I mean, you can't blame them for being cautious, but it's a cautious way for Bank of America and Wells Fargo, and other banks will adopt similar programs, for them to deal aggressively with some of their worst assets. Because if a homeowner isn't willing to sign up for such a program and isn't successful in making those payments, well, then they just take the home in foreclosure and they're no worse off. So let's see if there's anything else here I want to tip you off to. So it's kind of a graduated thing. Over a few years of proving your worth by making payments on the reduced amount, you get the amount forgiven. So it is a good program for just the right people, and that's the way that a lot of these programs are going to come out. They're going to be very targeted, and for certain people it's going to be exactly right. So